From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 21st, 2024. Let's check the calendar. The San Diego Padres are in this horrible city we call Milwaukee for the weekend. Then the Brewers hit the road for the rest of the week. The first of three Summerfest weekends is underway with Motley Crue tonight and SZA and her 20 million followers on Saturday. Where are they going to put them all? All right, here we go. In a small Canadian town of Larder Lake, they have a black bear problem, but it's Canada, so that's not unusual. But the bear has made himself at home in the local cars. He's figured out how to open car doors, even the locked ones. He's developed a taste for leather upholstery foam. That's got to be bad for his cholesterol. And then he locks the doors and crawls in the back seat for a nap. Isn't that the cutest thing you've ever heard? Unless it's your car. A video taken by a waitress of a man taking a blow-up doll on a date at an upscale restaurant has gone viral. The server, who says she was aware she wasn't supposed to be filming while at work, but couldn't help herself and captured the moment. Well, the moment cost her her job, but she's gone viral. And isn't that what we all want these days? And finally, back here in Milwaukee, local brewery Mobcraft is set to introduce a new beer. It's called Not So Horrible City IPA. The new brew is described as having sweeter notes which will overpower the bitter hops representing Milwaukee's sweeter side. The estimated release date is July 8th, a week before the Republican National Convention. If you'd like to pre-order a 4-pack, just go to www.horriblecityIPA.com. I may start drinking before July 8th. And on the podcast today, we have Dave Sandstrom, Adam Bailey, Joel Driesing, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. A pretty decent week overall, although the NASDAQ flat on the week, virtually unchanged. After starting the week at 17,689, closing at the same spot. The S&P 500 up 33 points. That's up 0.6%, closing at 54.65. And the Dow Jones Industrial Average, a fairly strong week, up 1.5%, up 560 points this week to close at 39,150. For the year now, including dividends, the NASDAQ up 18.2, the S&P up 15.2, and the Dow up 4.7. You know, Dave, I think the challenges this week, a holiday shortened trading week, 4-day week, the challenges this week fairly limited. There wasn't a whole lot of news, and yet we got a mix of pretty good and bad days, and in particular a rougher day for one stock on Thursday. And it seems to be a lot of what's driven the bus on the market more broadly. The reason I think why the Dow was so positive and the NASDAQ was flat, you need only look at NVIDIA.
Yeah, Colin, I think you bring up a good point about the lack of definitive news stories this week or data points coming out or no major Fed speak happening. What typically can happen then is you can have a large company really swing markets. Volume is low, and so you get somebody like NVIDIA having a tough day on Thursday after a pretty spectacular run for the company. It can swing things pretty dramatically. And I think it's just another stark reminder for us that diversity is so important in a portfolio, and to hook your wagon to one big name like that can be give you a little indigestion at times.
Yeah, the NASDAQ has been just riding the coattails of NVIDIA for the past many months, and good days and bad days, certainly riding the coattails on the way up, added to some volatility this week. But to your point directly, make sure you have those dividend payers. Dow Jones Industrial was up 500 points this week, 1.5%, still very close to that 40,000 threshold that we set not too long ago.
I think that's such an important reminder. And, what I hear from both of you is, maybe there's some reasons why we own some of the high flyers. But owning them in the right proportions is part of the key, and not getting too far over our skis. NVIDIA became the world's most valuable company on Tuesday within basically 48 hours or, two kind of trading days. We had gone down 6.5%+ on the stock. And so, yeah, it's still way, way up from where you were a year or two ago. But if you're betting on that one thing that's the high flyer, every once in a while you can get whacked going the other direction. And I think that's what we saw Thursday, Friday. It's what kept the NASDAQ from being a pretty positive week overall. And Adam, maybe some reminders in there about why we don't look strictly at just what has the most potential for growth.
Yeah, in part because there's a lot of really good companies trading at reasonable prices. NVIDIA, it's definitely gone to the moon. And valuations tend to be a little bit high at that point. But there's a lot of good companies at good prices, and outside of just the technology industry, you got to wonder, after going so far so fast, is gravity setting in terms of valuations on growth stocks? We haven't seen the dividend payers or the Dow Jones Industrial Average, or even all throughout a third, which is just non-U.S. stocks. They just haven't had their comeuppance in the way that technology businesses have. And as a reminder, you just got to hold all of those areas at the market for no other reason than diversification.
And of course, Dave, I think you look at some of the opportunity that's out there. You pointed out in some of our kind of emailing before the show just how expensive some of those growth stocks are, as opposed to maybe some of the other opportunities that we've talked about at length. But, I think some good reminders potentially in some of that data.
Kyle, it's interesting. It was a big week for appointments this week. A lot of clients in the office, and consistent questions were, when is this tech rally going to end? And when is the Fed going to cut interest rates? And I always remind investors that don't try to guess at the things that we don't know the answers to. But pay attention to those things that we do know the answers to. And we know that this week the growth sector, the forward Ps, eclipsed 150% of their 20-year average. Now, I can't tell you when or how that ends, but I can tell you pretty definitively that's expensive. I mean, historically speaking, when you exceed the average by 50%, that's a big number. And also, when it comes to interest rates, trying to guess when rates are going to decline isn't really the conversation. The conversation should be rates are attractive right now. I mean, we've come off of a decade of zero interest rate from central banks. And, with a 10-year north of 4%, corporate bonds somewhere in the 5 and 6% range. I mean, those are some pretty attractive yields. And so instead of trying to guess and play timing games with the markets, do what you know and stick to your strategy. And I think take advantage of those things that are good deals right now.
Yeah, and I think there's a tendency to look at what has worked and just kind of extrapolate out, well, that's the thing that's going to keep working. And I think it speaks exactly to what you're getting at, Dave, which is, well, it may stop working eventually. We don't know necessarily what's going to cause it to turn. We don't know exactly when that's going to be, but we do know some other things. We do know there's some deals out there. We do know that there's a pretty good rate of interest on safe money. And so absolutely, I think that should be part of the conversation.
We also know that market leadership doesn't always repeat itself. Sometimes it does year to year, but it doesn't forever. And those that have led the charge higher, eventually they have to pass the baton off to other businesses or other areas of the markets. But, one of the things we just know for sure is you never want to overpay for an asset. You always look smart buying a great company at a good price, not necessarily a good company at a lofty price.
Yeah, I think, the challenge right now for investors is we've entered maybe a month stretch where there's just not going to be a lot of news. The Fed just had their big announcements last week, and, the market responded to, kind of the changing expectations. It's really going to be a month before we're into the bulk of earnings season for the S&P. And so we really are in an environment in which some just weird headlines, a geopolitical surprise, or maybe an economic data point that normally wouldn't hold a lot of weight, but which all of a sudden does, can really push markets in kind of meaningful ways. And it isn't necessarily even a volume conversation. It's not like there's a lot of shares trading hands. It's not like there's a lot of people at the table. It's simply that what we are seeing is that one piece of news maybe had a lot of motion in one direction. And so I think it's a good reminder as well that you're not getting a lot of information right now that should really change how you feel about investing. some of the worst times to respond emotionally are the times in which you don't really have information to go on. And so if you're making decisions about your portfolio right now, you really should be making them with kind of the longer term view in mind, not just, well, where do I think stocks are 6 months from now? Are they because they're a little expensive now? You really want to be making those decisions based on kind of the long-term expectation. And then, Joel, we got some of that economic news this week. Not a terribly large amount of what I would consider to be maybe meaningful data, but the biggest one to me that we continue to keep an eye on is just how the housing market looks, and a lot of information on housing this week and just building more broadly.
Yeah, Kyle, housing is weak, and we actually had some numbers this week that showed how weak it is. They had the housing starts and building permits for May, and both of those numbers on an annual basis were the lowest they've been since June 2020. So, a couple of months after the onset of the COVID pandemic. So that's, pretty low. They also had numbers on existing home sales. We got those today from the National Association of Realtors, and those continue to be low and get lower. And the one hope that the realtors see is that there are more houses coming onto the market, and that's going to help give people more choices and maybe encourage more people to buy houses. It's going to help people move around maybe a little bit because there's going to be more housing stock out there. But it's also going to, with the supply and demand sort of thing, if the supply increases, maybe the prices of houses won't be rising as fast as they have been. The realtors in their report today said that the median home price in May was for $419,300. That's the median price. That was up more than 5% from the year before, and it's a new record.
Well, and I think as we look at that housing data, it's another reminder that the headlines are pretty mixed, even if the data itself has been painting a picture of high prices but slowing sales. I saw a headline this week pointing to some of the bigger markets, Florida, California, seeing some more significant decline. And I think it's a reminder how regional sometimes those conversations can be, but also a reminder that, interest rates have been a big part of this conversation. And unless we get some movement there, you still have a pretty meaningful affordability problem. Beyond maybe housing data, Joel, also some retail sales data, which tends to be a bigger kind of indicator of how the economy broadly is doing, given how much our economy relies on consumer spending.
Sure. Consumers drive 2/3 of the economy, and retail sales are one of the biggest measures of that, and it was weak in May, and it had declined in April. So, it's not looking real strong. But all that said, weak housing, weak retail sales, weak consumer spending, it's still going forward. We had numbers today from the Conference Board on leading economic indicators, and they're showing weakness too, but it's not as weak as it was in April. It's less weak in May than it was in April. It's less weak the last 6 months as it was the 6 months before. And the Conference Board, using this list of economic indicators all last year, most of last year, was predicting a recession, and they're not doing that anymore. Even with their numbers today, they said that they're seeing mild, marginal growth in the middle half of this year. So despite the weakness, which, that weakness is in part, as you said, from interest rates, and the Fed raised the interest rates to try to tame inflation, and so they've slowed down the economy because of that, but the economy hasn't gotten to the point where it's actually taking a step back yet.
One of the things I noticed this week was the industrial production numbers, which were pretty decent. And you contrast this against what we had been talking about maybe a year ago as the service side of the economy was going gangbusters, but the industrial production side was just kind of hanging in there. And we've seen some of the pickup. And if you're producing goods, you don't make those goods if you don't think you're going to be able to sell them next month or a month down the road. So it's good to see an increase in industrial production, even capacity utilization, at a time when some other areas are just showing some slowness.
Well, and it used to be in our country that if you had that industrial weakness, it was a sure sign that the recession was here. and we are such a different economy now that, I worry less about the manufacturing base. Certainly it's important, certainly from a job perspective and a growth perspective. You want strong manufacturing, but it isn't as critical to kind of the viability of our economy as it used to be. And so, I think it's encouraging to see it, and I think it's, at a time in which we're trying to build that base back up, it's going to be critical that we have that kind of strong foundation to start from. So, I think it's worth pointing out.
And Kyle, I just read a brief from the Federal Reserve Board of St. Louis today about how slowdowns usually happen and recoveries. And what they pointed out is that, and we've mentioned this before too, but in this report they said usually when an economy is coming back from a slow period, as we had, with the COVID pandemic, it's usually the manufacturing, the durable goods, the hard stuff that goes down first and recovers first. And then it takes a longer time for the services and especially housing to come back. And there are all sorts of things with housing. You're mentioning interest rates. We're mentioning supply. And the other thing is demand. I mean, just demographics and how different that is than in past slowdowns. That's going to take a while for housing to come back.
Well, so maybe one more thing this afternoon before we wrap for the week. Just a reminder on the importance of, good cybersecurity, good protection of your own personal information. We had another instance this week, and there have been a number of high-profile. It feels like, maybe one or two a week that seem to be coming out, but we had another high-profile cyber attack this week with one of the main suppliers to car dealers. The car sales business is a $1.5 trillion business here in our country, and so it's a big deal when that business is being impacted. A lot of deals not happening right now because these dealers don't have access to the systems they need to make them happen. And that on the heels of finally getting some clarity on the Ascension hack that took place. Now it feels like a long time ago, but finally got some clarity last week, that it was simply someone allowing in access to a system because they allowed some stuff to happen that they shouldn't have allowed to happen. And so a pretty good reminder that when you get an email, be suspicious of links, be suspicious of photos. If someone's reaching out to you and you weren't expecting it, maybe think a little bit longer and harder about whether or not you should be clicking into that email. And so, again, I think our public service announcement regularly, just be real careful with your information.
Always be vigilant.
You got it. With that, and with the cap on what's been a pretty decent week and a pretty decent stretch so far, we will enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.